This is Business Weekend with Ross Greenwood.
Hi and welcome to Business Weekend. I'm Ross Greenwood. Thanks for your company. Coming up on the program today, in a week dominated by East Coast floods and action resulting from Russia's invasion of Ukraine, we get the latest from the markets and the insurance industry, including the boss of Australia's second largest superannuation fund, who this week announced the sale of $130 million worth of Russian shares. Also, the boss of Australia's competition and consumer watchdog is standing down after 10 years in the job. ACCC Chairman Rod Sims opens up the Business Weekend about corporate behaviour and bringing to heel the world's biggest technology companies. And in the wake of one of the greatest scientific breakthroughs in the past 100 years, the creation of sustained fusion energy, just like the sun and the stars, except right here on Earth, we discover that though Australia's a big part of that discovery, our government, well, has it really paid its way or not?
Accessing fusion power is much harder than putting man on the moon. And putting man on the moon costs $130 billion US.
But let's start the program with the deadly floods that have so far claimed tens of thousands of houses and displaced hundreds of thousands of people. As we explained a few weeks ago when we spoke with Suncorp's Chief Executive Steve Johnston, the insurance industry wants to turn flood and bushfire mitigation into an election issue. The tragedy is that so many people affected by these disasters have no insurance whatsoever, simply because they can't afford it. And they've not been protected by government-paid-for infrastructure. The Chief Executive of the Insurance Council, Andrew Hall, joins me now. Andrew, many thanks for your time. You know, it's only 2 years ago since the bushfires we saw had a massive impact on people's lives. Now floods are affecting people. And yet, quite clearly, there are so many people in our community not insured, not protected. Is it realistic to say now that government has to step up to help protect people?
Well, thank you for having me on, Ross. It's a critically important conversation we need to have off the back of now a decade of a number of extreme weather events. The bushfires you mentioned, I think the total cost there in insurance terms was $2.6 billion. As of Friday, there were 67,000 claims already lodged with insurers. 57,000 of those were from Queensland. So I'm very concerned that those communities on the Northern Rivers who have been without power and telecommunications are yet to even be able to contact their insurer to get help. So this is an unfolding event. It will be a very expensive one again. And for those communities that have been hit, particularly Lismore, I have grave fears for how that community will respond. And it just means that we really need to talk to government around how we can put more money into resilience and mitigation up front rather than the billions we will spend on this cleanup.
Okay, because the one issue, and I've even looked at this, you mentioned a $2.6 billion insurance bill. That's not the infrastructure the government had to pay for that others uninsured had to actually pay for out of their own pockets. But even now, with this event, as you're pointing out, with the claims likely to go higher, the prospective insurance bill is already over $1 billion, but could go much higher because even compared with previous flood events, the number of claims, the trajectory of claims is so much higher.
That's correct. And we're seeing these extreme weather events occur more frequently. And with this event, it was actually a little bit unusual. It wasn't like the 2011 floods. It was literally a deluge that saw suburbs in the north of Brisbane, for example, experience flooding that have never experienced flooding. So it is redefining flood maps. It's redefining where the risks are. And if you think about insurance always prices the risk. And in the case of floods, they are very expensive and risky events. Australia has incurred more than $20 billion worth of costs from floods since 1970. And if we think forward, we simply have got to put more money up front into protecting some of these communities because we know where they are, we know what the threats are, and we know the infrastructure that needs to be built.
But there's also another fundamental issue here. As you redraw flood maps, it means that those people who have been flooded here for the first time suddenly find that their risk premiums go higher. Their insurance premiums, ironically, go higher as a result of the flooding that we've seen just over the past couple of weeks.
Well, every insurer has different risk models and different appetites, and they price their policies accordingly. But we've estimated that there's about a $2 billion gap in government funding for resiliency mitigation in this country. And out of that $2 billion, $1 billion is actually flood related. There's a need for about $500 million to go into local infrastructure like levees and floodways, and around $400 million into household like actually flood-proofing homes. And there are communities that understandably, they live where they live because they love it. They don't want to move, and we understand that. But we have to put work into making those homes more resistant to these events, because unless we do that, insurance will become more expensive. Reinsurance globally will go up for Australia, and the knock-on effects are real for people and household budgets.
Just a very quick one from you. Is there an argument that some developments, some land developments that have been allowed by state governments should not have been allowed on the basis that they have put people in harm's way?
It's absolutely clear. We've seen in 2019 the floods that swept through Townsville went right through a suburb that was literally under construction. And what we're seeing is, and this happened in Brisbane again over the last week or so, homes that are built on concrete slabs in low-lying areas are the most vulnerable. The water goes through, and it, apart from the mess it leaves, it damages all the electrical, all the plumbing, all the gas. This is poor planning at its very best. And as a country, we've got to have a conversation around how we approve development. And development pressures are real in cities like Brisbane and in Sydney. But we're just putting people further in harm's way as we keep approving developments on these low-lying floodplains.
Andrew Hall, Chief Executive of the Insurance Council, many thanks for your time on the program today.
You're welcome, Ross.
The other massive story of the week, of course, is Russia's invasion of Ukraine and the astonishing response from Western governments to impose swift and severe sanctions against Russian banks, energy companies, miners and oligarchs associated with Vladimir Putin. The ruble collapsed by 27% in the course of the past week. The Russian stock exchange, the MOEX, was shut, fearing a run on its stocks if people tried to get their money out. Some traded in London, some of the companies. Sberbank is one of the biggest banks. It, for example, collapsed more than 90% in London until the UK banned those Russian stocks trading through ADRs altogether. Now, while the fallout pushed energy and oil stocks through the roof, including here, nerves rocked the broader market. So let's bring in here the renowned value investor, Roger Montgomery from Montgomery Investment Management. It's fair to say, Roger, that value emerges when stock prices are volatile and when the whole market takes the good and the bad with them. Do you think we've got to that point yet?
I think we're getting closer. I don't know if we're at the bottom or anywhere near it at the moment, because remember, in the background, we've still got the rising interest rate story as a result of inflation. And inflation doesn't seem to be getting any better. I was of the view at the start of the year that we'd probably seen the peak of inflation. But of course, with what's going on in the Ukraine and the consequences, all the sanctions, that's going to keep a lot of commodity prices elevated. It's going to keep a lot of input costs up. And that was one of the big stories of reporting season as well for a lot of smaller companies. We saw a lot of companies complaining that inflation had resulted in rising costs for inventory, and that really hit their working capital.
And the interesting thing about it was those companies that did report rising costs because of inflation were generally hammered by the market because that outlook looked as though they were going to have their profits squeezed. Because the problem is, in many cases of companies, they can't pass on the increased costs. Unless they can do that vigorously, then quite clearly their profits are going backwards.
Exactly. And fund managers are trying to work out where to hide. How do you reshape the portfolio so that you don't expect it's not going to go down, but you want it to go down less than everything else. There's not many places to hide at the moment except for perhaps commodities, resources and energy.
Okay, so is that a realistic thing for people to skew it that way? Because your problem is, if there is a breakthrough in the Russia-Ukraine situation, miraculous though it might be, you've suddenly got energy stocks suddenly piling down as oil reverts back from nearly $120 US a barrel it's been at this week.
If you're not going to rebalance your portfolio on a monthly basis, if you're not super active, if you're setting and forgetting, then what we've seen historically, and I'm sure other people have told you this, Ross, but what we've seen historically, if you go back to all the crises since World War II, then what you find is that in the prelude to war, markets go down, and when the first shots are fired, markets tend to go up. And in fact, it might surprise a lot of people to know that in World War I and World War II, between 1914 and 18 and 1939 and 1945, the markets actually went up 8.7, or the Dow Jones went up 8.7% a year during World War I and 7% a year during World War II. So on average. So it might surprise people to know that even in war, markets can do quite well. So if I'm not a professional investor, if I was just going to buy good quality businesses and set and forget, then yeah, I wouldn't be skewing my portfolio because of the Ukraine situation.
Okay, so let's then bring it back home here a little bit, because one thing I observe is that there is going to be a lot of opportunities here. It's in agriculture because of Russian-Ukraine agriculture being disrupted.
Like Elders could be a takeover target.
Elders could be. GrainCorp is another one.
Another takeover target potentially.
Another takeover target potentially. And the second thing that's creating takeover targets here in Australia, such as these companies, is the fact that our dollar would appear to be artificially low right now because the Reserve Bank is keeping the interest rate so low. So that being the case, you have currently got coal prices at $440 US a tonne, right? Which is unprecedented. You've got iron ore prices through the roof right now. You've got oil prices through the roof. Under normal circumstances, the Australian dollar would be $1 US. It's not. It's 72, 73 cents.
Yeah, I think you're right. So there's a combination of what you've just described. You've got the cheaper dollar, but you also have a huge amount of money, billions and billions of dollars that have just been raised this year by private equity funds, new private equity funds. So they're going to want to place that money, park that money somewhere. And then, of course, you've got this whole ESG theme. Now, what that has done is it's raised the cost of finding new commodities. So building a new mine is more expensive. It takes longer. Getting approval is much, much harder. So supply is potentially constrained at the same time that demand is going through the roof. So there's a really, really strong argument that says commodity prices not only rise a lot, but stay higher for a lot longer. And analysts at the moment, the sell-side analysts, they're in their forecasts, they really anchor towards the cost of production. So arguably their forecasts for commodities are too low. And if they were higher, even by only a small amount, then the present value of a lot of these companies potentially goes up by twice the amount of the increase in the forecast price.
And what we're talking about is key and strategic assets for the world.
Indeed.
And so these are some of the finest mining assets, agriculture assets in the world. And with the Australian dollar being so low, this attracts the interest of international, if you like, private equity managers. It attracts, big international companies to try and grab some of these assets while the conditions are as they are.
In the Oz just over a year ago, so at the end of 2020, I said that 21 would be a big year for takeovers. So I wrote an article for The Australian. And I think that's going to continue this year. I think we're going to see a lot more of that. But I think you're right, it will be directed towards that space.
It's going to be fascinating. So what other themes are out there? Because as I started at the beginning saying that, everything gets washed out, but there's some very high quality stocks that tend to get washed out as well. So where are you if you like, putting your stakes in the ground? Because you're always watching, not always acting, but often watching.
Well, at a reporting season, 3 really high quality companies. We like to focus on very, very high quality businesses. And 3 were IDP Education.
Can I just pick you up there? Because your definition of a high quality company is one that's got a very high return on shareholders' capital.
Correct.
With very little competition that could disrupt that.
Yeah, ideally we want for a business to sustain a high rate of return on equity, it's got to have a competitive advantage. It's harder for other companies to replicate what they've got for a variety of reasons. And so 3 that come to mind are Seek, IDP Education, and also realestate.com.au or REA Group.
We should say a sponsor of this program, which is commensurate to any of this, right?
Partly owned by
that's right.
News. So those 3 businesses during reporting season, what was interesting is not only are they cracking businesses in their own right, but they've all got interesting optionality in India. So Seek, for example, reported that just in the month of December, they hit the #1 spot in terms of visits for jobs. And then you've got IDP Education, who've just bought Cambridge's stake in the India IELTS and the English language testing and also university placement business. They've just bought that from their partner. So they'll be able to lift the price of that product in India because it was underpriced compared to the rest of the world. So you're seeing a lot of these businesses, high quality businesses with optionality in India. I thought that was one theme that emerged that was really interesting. And the other one is robotics. What we've seen, and we talked about this just before we came on the program, or before I came on the program, but we saw Coles investing $100 to $150 million in robotics to help deliver more efficiently.
Through the company Ocado, right?
Yeah, through
the
Ocado.
UK company.
That's exactly right. And so what they're going to be doing is they're going to be basically replacing a lot of jobs with robots. And remember, robots work 24/7. They don't have a smoko. They don't take a toilet break. They just keep going.
Roger, always good to have you on the program. Many thanks for your time.
A pleasure, Ross.
Now, in Australia, as we've been discussing with Roger, our economy is likely to improve with the Russian sanctions pushing up, as it has, energy prices, gold, wheat. And the uncertainty also takes pressure off the Reserve Bank from immediately raising interest rates. But one group that took action was our superannuation funds that answered a suggestion that they should dump their Russian investments. One of those that did this is the Australian Retirement Trust, now Australia's second biggest superannuation fund after a merger between QSuper and SunSuper was completed this week. And Chief Executive of the Australian Retirement Trust, Bernard Riley, joins us in the studio now. Bernard, many thanks for your time. I just want to start with the action that you have taken. Australian Super has done a similar thing. So you've basically had $130 million worth of investments in Russian stocks that you've dumped. It's not big in the whole scheme of things, though, is it? But it's important.
Yeah, Ross, thanks for having me. It is important. We looked at it from a risk mitigation perspective. So $130 million is about 0.2% of the fund. So it is small and modest in that sense, but it is members' money. And so we need to make sure we protect their money. So from a best financial interest perspective, the team made the decision actually on Tuesday to instruct our external managers to liquidate those positions. And they've done most of that through the end of today.
I was going to say, though, that the Russian stock markets have been suspended. And, the London now has suspended those Russian ADRs that are there. It makes it a bit harder to do.
You can do what you can,
yes.
And then we'll still be left with a small position. And once the market opens up, we'll then exit that position.
OK, so this goes to the heart of our superannuation funds here in Australia. We know that they've exerted control over companies and boards in regards to executive pay, over some of their environmental risks that they have taken. And so we've got now what I'd suggest is a more active superannuation investment industry than we've ever had before, coming together to create this very large superannuation fund, only second to Australian Super in Australia, but perhaps growing faster, you could argue. That gives enormous power over corporates, over behaviour in Australia.
I think, Ross, you're right there, but it is the approach we take is engagement. And so we don't like to use a big stick with companies. Our approach is, and we've had relationships with corporates for a long period of time, so our approach is to really engage with companies on issues such as ESG or other matters that arise from time to time and try and get the right outcomes for our members, because at the end of the day, it's about that financial outcome for our members.
It's the financial outcome for the members, which also drives the logic of QSuper and SunSuper coming together. But you can say it pretty easily. The logistics of actually trying to bring two separate groups together of this scale is really problematic.
Ross, it took us 2.5 years to get to this point.
2.5 years.
And in the midst, we've had a global pandemic that hasn't helped, but it was complicated because it is two funds truly merging. Whereas often you hear in the industry talking about merge, but really to take over one over the other. This was a genuine merger of equals. And that takes time because you have to build consensus with a whole lot of stakeholder groups as you go through the process. We signed a heads of agreement in March of 2001. For us to be able to take things forward to get to the point of where we came together on Monday this week. So
2021, I would say. 2021. Just the other thing also about this, the scale is really important these days. We know that there is enormous pressure on superannuation funds to perform. That's part of the government's legislation to make certain that you're not falling behind. But a part of it is that if you've got scale, you can actually achieve investments that smaller funds can't, and you can actually achieve outcomes in terms of management fees that smaller funds can't.
That's correct. There's three main benefits that I see for us coming together. Firstly is those investment benefits. So opportunities for us to be able to access investments that we couldn't otherwise access, even for a $100 billion or $130 billion fund. In being able to drive the costs down with our external managers, so drive that scale gets us a better price point for our members. And then on the admin side, bringing together two admin capabilities, we're able to reduce fees, and we actually announced for the 1st of July that fees for our members are going down, so putting them at the front. And the third part, I think, which is really important, is the diversification in bringing these two membership bases together, that diversification of members. It changes the dynamic for us. So we're able to make those long-term large investments because we've got 40% of our members are under the age of 35.
So we've seen, say, for example, Australian Super, which is 260 billion, you're 230 billion. So the size is not that much different. We've seen them go into direct investments, in collaboration with others, with Sydney Airport, other infrastructure projects. So do you imagine it now that you are as large as you are, that this increases your appetite to take things private off the stock exchange to actually start to move into more of these direct investments?
We don't want to operate companies. We want to invest in companies on behalf of members, but we've also done a lot of deals like that already. So QSuper, in fact, part of the consortium with Sydney Airport.
Yeah.
And SunSuper bought a large chunk of Telstra towers earlier in the year. So we've started to do that, but this gives us the opportunity to take a bigger stake in some of those entities rather than just partner with others.
Because one of the things here, for example, in Australia, you see big infrastructure projects and you see the Canadian Teachers Pension Fund turn up all the time buying Australian infrastructure. Is this the way in which, say, for example, if we went to Canada, we might see your organisation suddenly turn up as, say, for example, an investor in Canadian or British or somewhere else in terms of their infrastructure?
Most definitely, Ross, because it's about diversification as well. So we don't want to put all of those unlisted eggs in the basket here in Australia. We need to diversify. And you've actually already done some of that. So we own a large chunk of Heathrow Airport, for example.
Yes.
And we've got other infrastructure investments across Europe where we'll actually partner with some of the funds you mentioned, like some of the Canadian funds or some of the European funds to actually invest in those assets as well.
And that's why, consequentially, you've also got investments in Russia, because it's about your managers diversifying the risk. I guess that's the other aspect here, isn't it?
That's correct, because diversification here for members is in their best financial interest.
OK, so then do you still use the external managers, or is it a case where you're now big enough to bring all of that management in-house?
Ross, the jury in my mind is out whether insourcing is better than outsourcing. And I think that a number of funds in Australia have done that, and they've done it successfully. But the time horizon still isn't that long, to be honest, to determine whether it's been fully successful or not. We're taking a look at what we do. There's definitely more we will do in-house than we do today, but I'm not sure we're going to go to the same extreme as some others. OK, and then the final aspect of this as you go forward, thinking about the way you invest, you've already said it, it's about the members. It's about getting a better outcome. But one of the things about this is to try and have a broad spread of members, so you don't have too many who are too old going into pension phase. You don't have too many who are too young, who both don't take up some of the insurances and so forth. So it's about trying to get that balance right as well. That's correct. So as I mentioned earlier, we've got 40% of our members under the age of 35, 20% over the age of 55. So it gives us a nice spread of members. We've got 75% of our members today in Queensland and 25% outside of Queensland. So there's a geographical spread as well, and that's something that we will focus on going forward. And then there's that demographic spread.
Bernard Riley, the Chief Executive of the Australian Retirement Trust, we appreciate your time.
Thanks, Ross.
Coming up after the break, after 10 years in the job, ACCC Chair Rod Sims is standing down. He joins us next. Plus, a scientific breakthrough. The promise is plentiful, cheap electricity with no radiation and no carbon emissions. So, why is our government seemingly dragging its heels to play a part? Welcome back to Business Weekend. Good to have your company. After 10 years in the job, Rod Sims, the boss of Australia's competition and consumer watchdog, the ACCC, is standing down. Now, in that time, he's ramped up penalties against individual companies to more than $100 million. That's for a single offence. He's tackled the biggest tech companies in the first action of its kind in the world and also sought to change corporate behaviour. Now, caught up with Rod Sims this week and asked him whether he thinks that behaviour really has changed.
I think so, Ross, because we've got a lot more respect for consumer law as the penalties have gone up, as we've made more creative use of consumer law. So I think you've got a lot of companies now where if you talk to the chairs or the chief executives of our biggest companies, they would be a lot more aware of their need to comply with consumer law, and they would be pushing their companies to make sure their compliance is up to scratch. So I think that's been helpful. I think we've moved things on the privatisation debate as well, which is a slightly different issue. So I'd like to think yes, Ross. Hope so. OK, so then the second part about this is, a part of that is that you've been a regulator that's been prepared to take cases to court, to prosecute. Is that the role that you believe of an effective regulator? Oh, I think you have to do that, Ross. I mean, when I arrived at the ACCC in 2011, we had a 100% success rate in the cases we took on. which said to me perhaps we're being a bit too conservative. At the moment we're winning 80-85% of our cases, and I think that just pushes the boundaries a bit. No, I think you need to be, frankly, an aggressive enforcement agency, because then companies know you will enforce the law, and that then allows you to do a whole range of other compliance things. I remember, Ross, when the GST was taken away, the ministers in the government could see that the companies immediately passed the savings back, because they knew that if they didn't, we would take action. And again, when we had the pandemic and companies perhaps weren't giving consumers the refunds they needed, again, we just had to approach them and behaviour changed. So I think a regulator or an enforcer needs respect.
The issue in regards to the banks, the cartel case, the Deutsche Bank, the ANZ and the others that were involved, Citi, that was lost. Was it worth losing?
Look, we think we made the right decision at the time, Ross, so worth losing is a big tricky question. I'll just leave it that we thought we made the right decision at the time, and you hand these things over to the Commonwealth Director of Public Prosecutions. I think we have to remember, I mean, we investigated the behaviour, then we sent it to the Commonwealth Director of Public Prosecutions, who spent a year looking at it, and they decided to prosecute. And of course we had an immunity applicant who felt there was something they had to come and tell us about. So people who say this is cut and dried and should never have been taken, look, I understand a legitimate issue about whether it should have been taken as criminal conduct or civil conduct. I understand that debate. Hindsight's a wonderful thing.
Do you think, however, that for the whole banking industry it may have changed behaviour, even though you lost?
Oh, look, so 2 points, Ross. I've no doubt it did, because you hear that all the time. I mean, I've heard that from bankers, I've heard that from lawyers, I've heard that from people who work on bank boards, that they've absolutely taken notice of that, and they've increased their compliance, and they've worked out a whole range of things they just shouldn't do anymore. So I've no doubt that's true. We don't take cases on that basis. We don't take cases to lose them and send a message. But you're right, I think a message was sent.
Okay, one of the celebrated issues that the ACCC has been involved with has been with our digital giants, Facebook, Google, Amazon, Apple. Now, in this regard, it was trying to bring these companies to heel in terms of what you saw as anti-competitive behaviour. Indeed, this was really, sort of world-first action that the ACCC took. Was that perhaps one of your finest moments as the chair of the ACCC?
What we did in Australia was write up how it all worked, how the ad tech world work, how the apps work, how search works, how Google pays an enormous amount of money to be the default search engine on a whole lot of equipment manufacturers, a whole range of things that people hadn't seen come together, including with the implications for use of data and a whole range of things. So while other people were taking quite narrow cases, we shone a light on the whole thing. So that's been very good, and I think it's got worldwide attention, which we are certainly very proud of. And of course then the other one is, which is almost, by definition world leading, was the News Media Bargaining Code, yes, because that just has not been done
where those
else.
Digital leaders now pay for content.
Yeah.
And that again changed the behaviour of those big digital companies, because they did enter the deals, not just here but around the world.
Well, they haven't. I think the deals they've done, so they're basically paying over $200 million a year to Australian media, which, when you think about the economics of Australian media, that's a very large amount of money. They've done deals that the media companies are largely, or I think almost completely, happy with. Deals that they could negotiate individually to suit both sides, so we're pleased that that's how it's come about. But I think, Ross, other countries are looking at it, but I don't think they've done it yet. I mean, Canada is looking at it, the UK is looking at it in different ways, the US is looking at. So it's been copied in thought and in concept, and laws hopefully will emerge that copy it, but it hasn't been done yet. So I think Australian media are in a much better position than media in other countries because of that code.
Can I take you to some of the big penalties that have actually been issued as a result of ACCC action? AIPE, an education company, $153 million.
Yeah.
But the company went broke. So this is a company that got money from the government, misused it, really ripped off.
Absolutely awful.
Is it worth fining a company $153 million if they go broke?
Yes, because it sends a signal. I mean, in 2021, we had a 50 million penalty against Telstra. We had a 125 million penalty against VW.
I was going to mention
both of those paid, yes. So the budget is the winner out of those. The AIPE one was 150 million, and what that does, Ross, you've got a judge who's got to make a ruling on this, looking at the behaviour and saying that behaviour, and given the size of the company and all the rest, that behaviour was such that they deserve a penalty of $153 million. Now, that means that when we come across other companies who still exist, they might be larger companies, Ross, and you might say, oh, that behaviour is pretty similar. They're an even larger company. 150 million was the benchmark there. It could be higher over here. Now, look, we're not seeking penalties just to improve the Treasurer's budget, although that's a side benefit, I'm sure, for the Treasurer. It's just to send signals. I mean, when we were getting consumer law penalties of 1 million 10 years ago, why would a board even have it on the board agenda of a company? But when the penalties are getting up to 50, 125, 150, and I think they'll, in some cases, go high where we see bad behaviour, then it's on the corporate board agenda. And board members will ask chief executives and senior executives, how did this happen? What can we do to prevent it happening again?
Okay, final one for you. You'd recommended to government that the ACCC be involved when mergers are on the table. And that has been now parked beyond the election by the Treasurer. Do you think that will ever become a real issue for the ACCC, that it will have a say when two organisations try and get together?
Yeah, well, we have an informal say at the moment, as you know, Ross. They often come and seek our informal opinion. Look, the Treasurer didn't so much park it. I mean, when I gave the speech, I said, we are in the middle of a pandemic. One of my golden rules is I never ask a politician to do something I wouldn't do if I were them. It's a key test. I try and put myself in their shoes. And if I was the Treasurer, I wouldn't look at merger law this side of the election. Back then, the pandemic was full on. And even now we're doing, the Treasurer's preoccupied with things with the pandemic. So I put it on, when I raised those issues and said we need a debate about this, I said this is something for government. Let's have the debate now, but this is something for government's post-election. Now, I read the Treasurer as simply saying that. We'll see where it lands post-election, but I'm very confident we'll get change.
Well, Rod Sims, we've done this many times during your 10-year tenure. I'll just say thank you for your availability. You've always been publicly available, and so I wish you the very best in your retirement, and thank you so much for your time.
Thanks, Ross. Thanks for always being interested in our issues.
Now imagine a world that's powered by clean, plentiful electricity, baseload energy, like that created by coal-fired power stations, nuclear plants and hydroelectric schemes. But this new form of electricity has no emissions, no radioactivity, no environmental impacts, and it will be plentiful for thousands of years into the future. Welcome to fusion technology. It's the exact opposite of the science that creates nuclear energy. Since the first atomic explosions, human beings have understood the power of splitting uranium atoms apart. It's called fission. But we have learned, unfortunately, the dangers when things go wrong. For as long as the planet's existed, the ultimate energy source has been right above us, the sun. Yet it's only now that scientists have, for the first time, brought the science of the sun to planet Earth on a sustained basis. It's called atomic fusion.
Fusion is the process where small atoms, such as hydrogen, fuse together to form larger atoms, such as helium. And this is the process that powers our sun and all the stars in the universe. So really it powers all life on Earth. The breakthrough fusion experiment at the JET laboratory in the UK lasted 5 seconds. But that 5 seconds was long enough to prove it can be done. To create a star on Earth
The temperature generated inside the jet reactor was around 100 million degrees centigrade, almost 4 times hotter than the sun.
We know it works because it already powers the stars. If we can capture that energy, we can turn it into electricity.
Accessing fusion power is much harder than putting man on the moon. And putting man on the moon cost $130 billion. It occupied most of the US's science research budget for many years, and it was driven by a purely political driver to offset the Soviet Union at the time.
The reason the science is so difficult is that you need to smash isotopes of hydrogen together under intense conditions to create helium, and in the process, it gives off enormous amounts of energy.
We'll use 2 isotopes of hydrogen. Deuterium, which is a hydrogen, twice as heavy atom of hydrogen. It has 1 proton, 1 neutron. And tritium, which has 1 proton, 2 neutrons. And those neutrons allow the fusion process to work at a much less extreme conditions than you find at the core of the sun.
Deuterium is relatively easy to find. In fact, most of us have swum in it when we've taken a dip in the sea. Tritium, though, is more difficult to find, but can be created by activating lithium. Yep, lithium, the same metal used in batteries. The problem is, once you have deuterium and tritium, they're both positively charged. Now think 2 positive poles on magnets. They just want to repel each other.
You have 2 nuclei of hydrogen positively charged. They repel each other. They do not want to come close. And you have to get them very close where another force called the strong nuclear force can take over and fuse them together into a single nucleus. And that means extremely high temperatures. The middle of the sun is 15 million degrees and billions of atmospheres of pressure. So very extreme conditions need to be created and sustained long enough to get good fusion power output.
The other reason the 5-second jet experiment is so important is another project 10 times the size in southern France called ITER, Latin for the Way. LITER, which is due to be finished in 2025, will cost around $32 billion and be funded by global governments.
JET is validating a lot of the design and operating parameters for the ITER reactor. And that's the reason everyone's so excited. This result means that we're even more confident that ITER will work.
Both JET and ITER are connected to nuclear power plants. That's to create the enormous amounts of electricity needed to heat the hydrogen atoms to the point where they'll collide together. But once a fusion reactor produces more electricity than it uses, the sky is the limit, and that is ITER's objective. To prove that fusion technology can produce more than enough electricity to not just power itself, but also to become the blueprint for future energy plants around the world.
ITER is a research experiment, so it's designed to explore this burning regime where the plasma is self-heated. And so that regime would be portable immediately to a power plant. It's itself, because it's a research experiment, it's not designed to produce power, but it will produce the scientific information that will enable a power plant to be built.
Once proven, the promise is endless amounts of clean baseload power. It's something you'd imagine Australia would be on board with in a big way. Well, the scientists at ANSTO and ANU are, and the people running the ITER reactor as well.
ITER organisation and ANSTO signed an agreement last year to allow Australian scientists to come and participate in the multi-billion-dollar ITER project. We have reserved prime port space on ITER for a Doppler coherence imaging system. Because coherence imaging is an Australian invention, Australia would be the best place to develop a system for the ITER tokamak.
That technology, crucial to the analysing of plasma in the middle of the fusion reactor, has been created by Professor Michael Hole's team at ANU in collaboration with ANSTO. There's just one big problem: money.
The agreement at the moment is a scientific and technology agreement. It's yet to be funded directly by the Australian government.
Business Weekend understands that in 2006, the Australian ITER Forum, representing this country's best fusion scientists and engineers, including our universities and ANSTO, sought $60 million in funding over 6 years. Matthew Hole is the chair of that forum. That request for money was revised in 2014 to $16.3 million over 5 years for a development prototype. It also went unfunded. ANSTO received separate funding from government, around $500 million in the past 5 years, to develop its many applications, including nuclear medicine. It has not made direct requests to government for money for the ITER project.
Definitely, we need to be on board, and I think if you look at how much we've put in the ITER project, it's a very small amount that we stand to get enormous benefit from.
Business Weekend contacted the Science Minister, Melissa Price. A spokesperson told us all ITER components are already contracted to the current members and much of the work has been completed. While there may be opportunity for further engagement in specific bodies of work in the future, such opportunities would need to be considered on a case-by-case basis. It bears saying that the Clean Energy Finance Corporation, run by the government, has thus far made total investments of $9.5 billion, 150 times the amount that the fusion scientists originally sought. It leaves some of our brightest energy scientists imploring the government to fully understand and fund this technology of the future, technology that could, within 3 or 4 decades, fuel planet Earth for an eternity.
But the benefits are such that we've been chasing this dream for decades, and they are very high energy output, almost unlimited fuel. We can run for thousands of years by the amount of deuterium that's in our world's oceans, for example. There's no greenhouse gas production, so it's low emission power. There's also no possibility of a major accident with fusion. If something goes wrong and the plasma inside the tokamak escapes, it just hits the walls and cools down.
Fusion is a very promising technology. It offers all sorts of the attractions of baseload power with no proliferation risk, very low levels of radioactive waste which are associated with activation of the facility itself. And if you look at that energy promise, it's got to be worth a go. It's got to be worth an investment. ITER is a tiny fraction of the world's investment in total energy. It's got to be worth at least exploring whether this is going to work.
After the break, the impact of Russia and inflation on the future of interest rates and housing with Westpac senior economist Matthew Assan. Thanks for your company here on Business Weekend. Now, one of the consequences of the Russian invasion into Ukraine has been uncertainty about the future of the global economy, with higher energy prices likely to add to inflation around the world and here in Australia. But the uncertainty short term is also keeping the Reserve Bank from raising interest rates anytime soon, despite the Federal Reserve Chairman Jerome Powell this week saying US interest rates will start to rise when the Fed meets in just under 2 weeks' time. Here's a little of his testimony to the US Congress this week.
I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike.
But if you think about it, that decision impacts every homeowner and prospective buyer right across Australia. Rising inflation puts even more pressure on interest rates long term. So let's bring in here Westpac senior economist Matthew Assan. Matthew, always good to have a chat to you. This is a conundrum right now, isn't it? Because on one hand, you've got, that risk of the global economy sort of getting weaker. So that means interest rates don't touch them. On the other hand, you've got inflation rising. That means actually we better start to raise interest rates. So there's an issue here for people think about buying a house, in business, whatever it is. You've got to make a decision right now.
That's right, and it's a conundrum for the RBA as well. Most of the time they need to look through these sorts of events and have a view for the medium term. We know Australia, yes, petrol prices are a big factor for our CPI. It's an inflation burst, but it'll presumably unwind over the medium term. And other aspects of this crisis are actually quite positive for Australia. If you think about commodity prices, we're a net energy exporter. So we get a wave of a windfall gain for our energy exports. Won't flow through to many households, but it does flow through to the wider economy to some extent. So it's really tricky territory for the RBA. I think alongside that, it's the other things that make this really tricky. The fact that we're seeing a more generalised inflation globally around goods associated with supply chain disruptions, not just energy, and that we've got this move in the labour market locally, which is about to hit extremely tight conditions that suggest that medium-term view on inflation is not going to be so benign, and they will need to move at some stage question, of course, is exactly when.
And so there are even figures out this week showing that even though Australia's borders have opened, that we haven't had the mass inpouring of labour that we might have anticipated. So in other words, at this stage, lots of people, like Australians, are kind of prepared to stay at home. That doesn't help our labour market. That really doesn't help to take pressure off the wages.
Yeah, certainly right here, right now. We are starting to see some early signs that that's starting to shift. Our Westpac card tracker data looks at credit and debit card expenditure, and we have seen a significant quickening in travel-related spend. I think people are locking down the flights for those trips, whether they're domestic or international, a bit hard to tell at this stage. But certainly the influx of workers to refresh the labour market domestically, that hasn't happened yet. It may take time. It may be more restrained than expected. People are coming out of a pandemic. They're a little bit concerned about being left high and dry if we were to see a new variant and a new issue emerge. So I think, there are some huge questions facing the Australian economy, quite aside from petrol, global supply chain shocks, domestic labour market conditions, international borders. There's a lot of moving parts here. And I think, as you said earlier on, the RBA has taken a deliberately reactive approach to this policy move. They're going to wait until everything's flashing red before they move off the 0.1% cash rate. And that almost bakes in a mistake. If they wait too long, they could be playing catch up, and it mightn't be about whether they move this year, by May, June, July, August. It's how far they may need to move in total if they get inflation.
And the danger of that is if they raise it too quickly, they might just frighten the horses in the property markets and other areas. So again, this is the balancing act, because what you don't want to do is suddenly frighten your property investors, to frighten your property owners, and have them suddenly say, right, we're going to not buy, or we've really got big troubles here, because that wouldn't be good for the housing markets. That would not be good for Australia's economy.
Absolutely not. If you ended up that you're jumping at shadows, that the oil price spike reverses by year end and there's nothing left inflation-wise, if it actually maybe nobbles demand domestically because consumers have to meet these higher petrol costs, and if you've delivered too much of a blow for the household sector, for the housing market, then that's an issue. I think it's the sentiment aspect, the sentiment dimension becomes really important. We think the housing market will be pretty sensitive to interest rate moves. In the past, it's taken
people have got such big mortgages these days. Let's be honest. They've been able to borrow to their capacity. $500,000, $1 million is pretty standard these days in the major capital cities.
So the question around that is they've also accumulated very large reserves over the pandemic period. 250 billion as a war chest for the household sector to play with going forward. And to some extent, that could be drawn down as a buffer. About 100 billion of that is sitting in mortgage offset accounts. Really, though, the housing market's about that marginal buyer. What's that new buyer able to borrow? What's the burden of meeting those mortgage repayments? So we think it will be, in previous tightening cycles, we've got to go back a long time, right? We've got to go back a couple of decades to see the last tightening cycle. It took about 100 basis points before interest rates really bit in the housing market. You started to see things slow. 100 basis point was the tipping point where we started to move into correction phase. We think it'll be 40 or 50 this time around. But there's still, again, there's a few open questions around that.
Well, as I always say, Matthew, it's always the last interest rate rise. That's always the one that does the biggest damage of all. Thank you so much for your time. Matthew Assan there. So that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday. But don't forget, you can keep up with all the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time. Thanks for your company. I'm Ross Greenwood. We'll see you next week.